Is an analysis of VOYG's recent 8% stock gain, asking if it's a short-term trade or a long-term investment. So let's get right into the first major challenge here, which is credibility. The immediate dissonance between the report's title, labeling VOYG's a penny stock, and its actual trading price of $27.41 instantly compromises the material's professional credibility.
Right. I mean, you can see the goal is to create a big attention-grabbing hook. 8% gain in one day. Best penny stock to buy?
And that instinct is understandable. You want to grab people.
Of course. But why risk alienating the serious investor right out of the gate? It feels like you're sabotaging your own deep analysis before it even starts.
Well, that's it, isn't it? The argument here, as I see it, is that using a term like penny stock, which, has a specific legal definition under $5 for a stock near $30.
It just breaks trust. Instantly.
It does, because the analysis is clearly for people who understand finance. They're experienced. And this basic error in the headline just undermines all the great work that comes after.
Yeah, it creates a trust hurdle you now have to spend the rest of the report trying to get over.
The weakness isn't the hype. Hype is fine. It's that you're using a factually incorrect term that belongs to a totally different asset class.
And the target investor knows that. They see a $27 stock called a penny stock, and they start questioning your basic financial literacy.
Exactly. No matter how good the thesis is.
So the suggestion for improvement here is pretty clear.
It is. You have to pivot the title to accurately reflect what the stock actually is, a small-cap, high-growth company.
Focus on the real strengths, the defense plus AI sector tailwinds. I mean, that's the core of the analysis anyway.
You don't need to mislead to get attention. The real story is compelling enough.
And the analysis itself already has much better hooks. You don't have to lean on this inaccurate price definition.
Far better. We found a few concrete examples right in the script outline. I mean, for instance, you could frame VOYG as a small-cap rocket.
That works. It captures the high-growth disruptive feel perfectly.
Or, since the comparison is already in the material and it's so relevant, what about leaning into that?
The next Palantir.
The next Palantir. That immediately tells the story, right? It contextualizes the high valuation, the mix of defense, and high-end AI tech.
And there's another one in there that might be even stronger.
Is this the next defense giant in the making?
Yes, that sets a really powerful, forward-looking, high-stakes tone, and you don't lose a shred of credibility doing it.
And that one small change, that shift, it just boosts the authority of the entire report from the very first line.
It moves from cheap hype to credible hype.
Exactly. And that sets a much better stage. But, once you get them in the door with a title like that, the main body, the valuation, has to really hold up.
It has to withstand that scrutiny.
Which brings us to our second point, really digging into that core financial discussion. To make the overall analysis more robust, the report needs to more explicitly connect VOYG's specific technology niche, these AI-enabled ISR systems, directly to the justification for its elevated 10x sales valuation.
Yeah, this is interesting. The analysis does a great job setting up the skepticism.
It does.
It clearly lays out the bear case, the $100 million net loss, the high 10-times sales ratio, especially when you compare it to legacy players.
Like a Lockheed Martin, yeah.
That PS ratio is really the elephant in the room.
It is, and the comparison to legacy firms is the right context. But then the bull case that follows, it focuses mostly on these general sector tailwinds.
Right, rising defense spending, the defense plus AI sweet spot.
But it doesn't quite articulate why VOYG's specific technology justifies that premium multiple.
And that's the tension. If VOYG was just selling, standard munitions, that PS ratio would be absurd.
Completely indefensible.
But they're not. They're selling these validated AI-enabled intelligence systems. It's the whole reason they got that $21 million Air Force contract. The connection between point A, the contract, and point B, the high valuation, is there, but it could be so much stronger.
It needs to be bolstered, yeah. The weakness is that the analysis says the multiple is high and then just points to a general opportunity. It needs to show why VOYG specifically deserves that growth multiple.
Because of its technology.
Because of its technological superiority.
Right. So the suggestion for improvement is to really weave the uniqueness of those ISR systems directly into the valuation talk. You have to explain why the market sees VOYG as a disruptive tech firm and not just another defense contractor with a lower multiple.
It's about defining their tech moat. Why isn't this contract just revenue? Why is it proof of concept?
So for concrete examples, maybe we should look at it from a market differentiation angle. It's not just about the guaranteed revenue from the contract.
No. For instance, you could specify how this contract validates their proprietary AI. Is that AI the actual barrier to entry?
Right. If that $21 million is for a system that fundamentally changes how the Air Force gathers intelligence, makes it faster, more accurate, then that detail needs to be front and center.
Precisely. Because if the tech is genuinely disruptive, then that contract isn't just a number, it's a stamp of approval.
It's validation from a huge player. And it suggests the system is scalable across, all military branches? International allies?
That's what supports the 10x multiple. And using that specificity is how you counter the skepticism from the high PS ratio.
So the argument shifts from sector growth to technological necessity.
Add market capture potential. It adds a critical layer of defense to the whole valuation. Suddenly, the 10x multiple isn't a red flag. It's a reflection of a justifiable future opportunity.
And that's what an experienced investor needs to hear. They expect the high multiple, but they demand a concrete technical reason why it's deserved.
Okay, so let's look at the long-term verdict. This leads us right into the third major area of opportunity. The analysis's long-term verdict of speculative buy is weakened because it frames the future as this really simplistic binary outcome. It's based solely on either winning one more contract or missing one earnings report in 2026.
I see what they're going for there. You want to communicate that high-risk nature of small-cap defense tech.
Sure.
Dream scenarios. If they win another contract, it flies. If they miss earnings, it could drop back to $20.
Yes. And that makes the long-term thesis feel a bit shallow. It's missing any intermediate milestones. These non-binary growth metrics for an investor to actually watch.
Things to track along the way.
Exactly. If you're committing capital for the long term, you need things to check in on quarterly, not just holding your breath for the next big press release 18 months from now.
So the question is the connection between today's operations and future success really there? Right now, it feels like it all hangs on these external market catalysts.
It does. So the suggestion for improvement is to expand that long-term view. Identify maybe 2 or 3 specific intermediate growth factors that are not tied to winning a contract.
Things that would show the company can actually scale its tech and manage its spending.
We need metrics that show they're translating that $21 million win into real sustained operational growth, not just surviving on headlines.
That makes sense. And maybe you could also measure the efficiency of that growth. I mean, investors know the company's running at a huge loss, about 100 million TTM. That's the cost of scaling this kind of tech.
Right.
So what if the focus shifts from the size of the loss to, the efficiency of that cash burn?
That's a great point. How much growth are they buying with that 100 million? So a concrete example here would be to track the efficiency of that burn against the revenue growth in their defense and national security segment.
Which the analysis already says is growing at, 31%?
Around that, yeah. So if that revenue growth starts to accelerate, while the cash burn stabilizes or slows, that's a huge positive sign. And it's totally independent of any new contract announcement.
It's a tangible metric. It speaks to how effective management is. Another thing could be tied directly to that $21 million contract.
Operational milestones.
Yeah, tracking the successful deployment or the integration of those ISR systems.
So we're talking about specific delivery dates, successful field tests, initial deployment phases.
Not just the signing of the contract, but the actual execution.
That gives a long-term investor something real to evaluate every quarter, something that isn't just dependent on volatile market news.
And that's really the difference, isn't it, between a high-stakes trade that's all about a catalyst
and a defensible, though still speculative, investment thesis, which focuses on organizational progress.
You move from predicting a lottery ticket to monitoring a business.
And for a speculative buy rating, that's vital. It gives the person reading this a scorecard to follow. It's guidance, not just a prediction.
These are the kinds of adjustments that really focus on the forest, not the trees. It makes the entire analysis more robust and logical. It respects the intelligence of the person reading it.
Absolutely.